Hello, Jamie Trull here, your favorite CPA, financial literacy coach, and profit strategist. And today we're going to be talking about self-employment audit triggers. So what are the things that could potentially trigger an IRS audit if you are self-employed? And what really are your chances of being selected for audit if you are a business owner? Okay, so we're going to jump on into that. I know nobody wants to be audited. I will say it's not the end of the world, especially if you're keeping documentation, if you have all of the receipts and the various things that you need to make sure that you are covered in case of an audit, but it's still not a fun thing to want to do, and chances are they do come in and try to look for things to disallow. So while audit is not the worst thing in the world, right, it's something we probably all want to avoid. So let's talk about a couple of the things that you can do and some actions that you can take and some things to watch out for that could help you not get on the IRS naughty list. Now, the first thing and probably the most obvious thing is going to be making sure to claim all of your income. All the income that you made as a business or as a self-employed person needs to be claimed on your taxes. Now, of course, you're also going to offset those claims with any deductions and things like that that you have, but you want to make sure you're claiming your income. And one thing to watch out for when you do claim your income is that you want to make sure that you're claiming your income before fees were taken out. So what I mean by that is, let's say that you are using a payment processor to collect payment, right? Depending on the payment processor, you may or may not get a 1099 from them, but you want to make sure that what you're actually claiming for your taxes is before fees, so the bigger amount, right? And then you want to deduct those fees separately in a separate line item. Why does that matter? Well, especially when a lot of times you will get 1099s and those will be for the full gross amount, right? Before fees have been taken out. And what the IRS will do is compare the amount that you claimed on your tax return to what the 1099 says. And like I said, since most 1099s are going to show the gross amount before fees were taken out, then if you claim the net amount after fees, even though that was the amount that actually maybe hit your bank account at the end of the day, it's going to look like you're underreporting. So it's much better, and it actually ends up the same way tax calculation wise, to claim the full amount, right, before fees were taken out. So if you charged $100, but maybe you only received $97, you still claim $100, and then you take a write-off for the other $3 in another line on your tax return. So make sure that you're claiming all of your income, make sure that you're claiming the gross amount before those deductions so that everything matches up and it doesn't look like a red flag to the IRS. Now, the other thing that you're going to want to make sure to do, number 2, is to make sure that you are not rounding your numbers. Okay, don't round your numbers on your tax return. What I mean by that is you can round them maybe a little bit, maybe to the nearest dollar. You don't need to put cents in there, but you probably don't want to be having everything end in 000, right? So if the number is really 1,234, you want to put 1,234. You don't want to put 1,000. You don't want to put 1,200, because when your entire tax return is rounded, right? Maybe some lines actually work out to where they end in 0, and that's fine. But if every single line on your tax return ends in 0, the IRS will see that as a basically red flag that you just estimated it out and you don't have the actual numbers. So you want to make sure that you are representing the actual numbers and you're not rounding everything. Another audit trigger that I see is the miscellaneous expenses. Do not put way too much into that miscellaneous expenses bucket. That is going to be one of the things that is ripe to be looking at. I am an ex-auditor, albeit not an IRS auditor, but I was an ex-corporate auditor. I worked for one of the big 4 accounting firms for a while. And one of the things that we always did on a company's financial statements is dig into other. Because if you have something that you want to hide, where are you going to put it? You're going to put it into other. Other, miscellaneous, those types of things. So if you have a whole big number that's sitting in your miscellaneous expenses on your tax return and they are unexplained things that you haven't given them any context to, that can definitely be an IRS red flag. My 4th tip is to form a corporation. Hang on here, because I don't want anybody walking away from this video saying, Jamie told me I needed to go form a corporation so I don't get audited. Absolutely not. Never do that. You only want to be forming a corporation. And what I mean by that is a C corporation, or perhaps electing to be taxed as an S corporation, right? Those things, if that's the right entity structure for you. Now, if you aren't sure what entity type you should be, you are not alone. Talking to an accountant can be a really good idea, especially someone who specializes in various different entity types, especially around C Corp and S Corp requirements, because there are a lot of them. If you want to understand the difference between entity types and also some rules of thumb of when it might make sense for you to change, then I have something for you. I have a whole module, a whole bonus module all about S Corps in my Financial Fitness Basics program right now. We also go into entity types in depth, and we also talk about things like financial statements, P&Ls, balance sheets, cash flow management. There are checklists, there are templates in there that are fully plug and play. There are guides to help you with all things finance, accounting, and taxes as a self-employed individual. So if you're interested, there are lots of extra bonuses right now. Go check it out, jamietrull.com/basics. We also have an expanded version of what I'm going over here as far as IRS red flags. So you will get a full 7-page guide on all the different IRS red flags and how to avoid them if you buy Financial Fitness Basics. Now, if you want some stats to back up the fact that corporations are audited less often than other entity types, I've got some data for you. So, importantly to know, about 0.2% of S Corps are audited each and every year. About 0.2% of partnerships are audited each and every year. And about 0.4% of C Corps are audited each and every year. However, when we talk about sole proprietors, which also includes LLCs who have not elected to be taxed as an S Corp, that number is about 2.4%, especially if your income is in the range of, call it $100,000 to $200,000. That is an area where a lot of different sole proprietors are getting audited. Now, it's still a small percentage on the whole, so it doesn't mean you're likely necessarily to get audited. Still a fairly small percentage, but you can tell it's multiple times more likely if you are a sole proprietor or an LLC. Again, not the reason to change. However, if it is looking like it might be time to change, that might be something to consider, is the fact that you would be less likely to be audited as a corporation. And now my last tip, my last potential IRS trigger for audit is around your ratio of expenses to total income. So specifically talking about your business expenses to your business total income. And I have some stats for you on this as well. So the higher your expenses are as a proportion of your income, i.e. the more expenses that you claim as a percentage of your total income, the more likely you are to get audited. Why is that the case? Well, the IRS is really going to be looking for deductions that maybe you aren't truly entitled to. And so if your profit margins are showing up to be quite small, then that is an indication to the IRS that you're maybe writing off things that aren't actually ordinary and necessary in your business. Because remember, a business is for the intention of turning a profit. And therefore, if you're not making much of a profit, then the IRS is going to want to look into that a little bit. Now, a study that was done not too long ago determined that if your business expenses were 52% or less of your total business income, so essentially if your total profit margin was 48% or more, right, then you were less likely to be audited, right? That's the least amount of likelihood to be audited. If your profit margins were in the 52 to about 62% range, you had medium likelihood of getting audited. And above 62%, i.e. if you're spending more than 62% of the money that comes into your business within your business as business expenses, if your deductions are more than 62%, then you were at a higher likelihood of getting audited. So that's just something to keep in mind. Obviously, that is not a clear rule of thumb, but that's just some recent statistics to go by to determine how likely you may or may not be to be audited. Now, I think I said that was the last tip, but I actually have one more bonus tip for you. And that is, especially if you are an S Corp or if you are a C Corp owner and you work in your business, make sure to be paying yourself a reasonable salary. Okay, that means you should be paying yourself a reasonable salary, right, through payroll and actually withholding taxes on that salary portion. You cannot pay everything out to yourself in the form of owner draws. Why is that the case? Well, the IRS sees that as a way of you trying to get around paying payroll taxes. So importantly, if you are an S Corp and a C Corp and you aren't paying yourself any kind of reasonable compensation through payroll, right, as a W-2 salaried employee of your own business, that is a red flag. And if you are an S Corp and you are unaware of this, you are not alone. So again, I want to tell you a little bit about Financial Fitness Basics, my program that goes into all of this. We have a checklist for S Corps as well, included within the bonus module that goes over all the things that you should be doing to make sure that you stay in compliance as an S Corp. And also that's good for those of you who are thinking about potentially electing to be taxed as an S Corp, so you can understand more about what that actually means. So again, lots of extra bonuses. Check it out right now, jamietrull.com/basics, and I will see you in my next video.